In today's episode, I'm going to teach 3 moving average trading strategies that are perfect for beginner traders. Now, if we take a look at my P&L for today, you'll see that I'm up $22,225.25, which makes this a solid green day. And in fact, a few of my best trades from the week have been on the moving average trading strategy. In case you don't know me, my name's Ross Cameron. I'm a full-time trader, and I want to tell you at the very beginning of this episode that my results are not typical. I've been doing this for more than a decade. But if you're wanting to learn how to trade and you want to learn a strategy that is currently being traded every single day by a real money trader, this is the class to watch, and this is the channel to subscribe to. Now, I'll say at the beginning of the week, I had a feeling that the market was going to be pretty hot. And so I said every day this week that I double my daily goal, I will teach a full-length class on the strategy and the setup that day that gave me my biggest winner. And today it was on the moving average strategy, and it was on CREV right here. So let's go ahead and jump into the slides. We've got a lot to cover. We've got the slide deck, we've got the whiteboard, and we're going to have some live trading archives. So I'm going to go full screen on this slide deck here, and we're going to start with the first slide in this slide deck, the topics of today's class. So I'm going to break down for you the definition of the moving average strategy. We're going to share the strategy with you in today's class. And I'm going to talk about the pros and the cons of this strategy, because although it's a strategy that I like, there are some elements of it that are a little bit challenging, and it's really important that you understand them at the beginning. I will also share with you the skills and the tools required so you can start trading this strategy today. As always, if you're testing a new strategy like one of the ones I'm using, I encourage you to practice in a simulator before you put real money on the line. It works for me, this strategy, but prove that it can work for you before you put real money out there. Okay, so we're going to start with the definition of the moving average strategy, and I'll begin by defining what moving averages are for those that aren't familiar. Moving averages are one of the most popular technical indicators. And on almost every chart, you will see some type of moving average. There are different types, but you will see moving averages on almost any chart. And usually when you first load a trading platform and you open up a chart, you'll see some moving averages on that chart. So moving averages are calculated by adding a number of candles together and then dividing by the number of candles you added. So for example, the average of 5, 6, 7, 8, 9, if you add up these 5 prices, you would get the total of $35 if these are all dollars. And then you divide by 5, which would be the number of candles in this period, and you get the number 7. So 7 is the average. So when we see, for instance, the price squeeze up from 5, 6, 7, 8, 9, the average is going to be 7. Why is the average important? Well, when the price is above the average, it's bullish. And when it's below the average, it's bearish. So moving averages can serve as both support when the price is above it and resistance when the price is below it. One of the most well-respected moving averages is the 200 period moving average. 200 periods means it takes the average price over the last 200 individual periods. And in this case, I'm using it on a daily chart. So this is the average price over the last 200 days. We look at, let's say, for instance, the S&P 500, and you'll notice that anytime the price comes down to the 200, it's a buying opportunity. It usually bounces off that level and comes back up. When it's below the 200 and we're in a bear market, it comes up to the 200, fades off that level. So the 200 moving average is resistance when the price is below it and support when the price is above it. And that's specifically on the daily chart. But let's look at an example here of moving average support. This is the 200 moving average as well, but this is a 5-minute chart, which means this is the average price over the last 200 5-minute candles. And it's still well respected on the 5-minute time frame. And you can see here the price comes down to this level, bounces off it, and comes back up. So if you did not have this moving average on your chart, you probably wouldn't have identified this as a place to buy. But once you have it on your chart, you recognize, oh, we're probably going to have support here because this is a logical area where other traders are also going to recognize there's support. We've got the moving average there. So one of the things I often tell traders is that once you have your indicators set up correctly and you've been trained to use them, you're going to start to visualize buy and sell signals right on the chart that a beginner trader just might not see. It's not because they're not there, it's just because their eye hasn't been trained to recognize them. But your ability to recognize that this right down here is a buy signal can translate to you actually making money on that trade, as long as, of course, you're managing your risk. So the popular moving averages include the 200 EMA, the 100 EMA, the 50 EMA, the 20 EMA, and then the 9 or 10 EMA. Now, there's really two types of moving averages. There's the EMA and there's the SMA. So the EMA is the exponential moving average. And the way this works is if the price is increasing steadily, rather than the moving average going like this, it'll actually slope up like that. And the reason it does that is because it weights more recent price action heavier than price action that was from further back. So an exponential moving average is faster to respond to changes in price than a simple moving average. A simple moving average will be much more linear in the sense that it weights each candle exactly the same, whether it was 200 candles ago or it was 1 candle ago. So a simple moving average is commonly used for some traders, but most active traders are going to use the exponential moving average setting. So you could choose simple or exponential, and I'm going to choose the exponential moving average. So you'll see mine are EMAs, which stands for exponential moving average. So the 5 that we have listed here, of them, I actually only use 3. I use the 200 EMA, and I use the 20 EMA, and I use the 9 EMA. I don't use the 100 and I don't use the 50. Although there are some traders who will, I personally don't find them particularly helpful in my trading. I don't feel like they're as well respected, and I'm a big believer in keeping it simple. Now that's the KISS method, keep it simple, and then comma, stupid. So keep it simple, stupid is a concept with life, I guess, in general, but certainly with trading, to not overcomplicate your charts. Keep them simple and easy to read. And so that's why when we look at the next slide here, you're going to see a nice, clean chart. So look at this. We only have 3 moving averages on here. We have the 9, the 20, and the 200 right up here. Now, the reason some people use the 9 instead of the 10 is kind of interesting. The 10 moving average would sort of be most logical. If you're going to use the 10, then use the 20, the 50, the 100, the 200. But somewhere along the line, a lot of traders started using the 9 exponential moving average. And I joined on that bandwagon. I don't know if the idea is that your signal will just be a slight hair ahead of anyone using the 10. I think that's kind of the idea. The reason it would be that way is when we're using moving averages, we're often looking at crossovers. So you've got the 20 here, and then you get the 9 that crosses over like this. Well, the 9 is faster. So if you had the 10 would cross over right here. So if you want to be trading a crossover, you're going to use a shorter time frame. So what might happen is a few years from now, traders are going to say, I should really move a little bit ahead and start using the 8. That way I'm ahead of everyone using the 9. And then eventually everyone's going to use the 7 and then the 6 and the 5 and the 4 and 3, 2, 1. I don't know if that'll happen, but we've been using the 9 for me, I've been using it for a decade, so more than a decade, and it hasn't moved to the 8, but it's possible that it will in the future. Nonetheless, for right now, the 3 moving averages that I'm using are the 9, the 20, and the 200. I have the 200 in magenta, the 9 in this light blue, and the 20 in the light blue, and then the 9 in gray. So when we look at the chart here, you'll see that the 200 moving average is way up here at about $20 a share. Now, I'll talk about how I use these moving averages on different time frames and how I'm using them to help me see buy and or sell signals. That'll be as we get more into the strategy. Now, let's talk for a second about the alligator indicator. So this is an indicator that I think is a really interesting one. The alligator indicator is an indicator that uses 3 moving averages. It uses the 13, the 8, and the 5. So the way this looks on a chart is you've got blue, which is the 13. So we'll write that here. This is the 13. You've got the red, which is the 8 right here. And then you've got the green, which is the 5. So these are the moving averages right here. And these are supposed to reflect the idea as an alligator. So if the price is going sideways here, right? Let's just say the stock is going more or less sideways. These are small green candles. And then the price starts to move away and pull up right here. What's going to happen is what moving average is going to move first? Well, it's the shorter one. It's the 5, not the 8. So the shorter one is going to move the fastest. So this one's going to jump up like this, which means this is going to be like this, and this is going to be like this. And when it takes this form right here, and it actually has to go like this, you're going to have this crossover where you have green, red, and blue. So if you picture an alligator, this is the alligator's nose right here. That's the nose of the alligator. These are his teeth right here. He's eating, and this is the water line right here. So when the alligator's nose pushes through and crosses above, that is when you have a period of volatility and you want to trade. So when the alligator is eating, that's when we're seeing strong momentum. So that's when we're going to have this nice crossover. Then you get a pullback, the price dips down, and let's say it keeps going down, you're going to have a crossover back down like this. When you have a crossover back down, now the alligator is said to be sleeping, right? So now you get this full crossover where it goes negative. So the alligator is diving back down and it's actually going to sleep. So this is a moving average crossover. It's designed to help traders identify trends in the market and to only trade when something is trending. I'm a big advocate of this. If you don't already know a little bit about my strategy, I am a momentum trader, which means I trade with the trend. Ultimately, when it comes to active trading, there are two strategies. You can be a trend trader or you can be a counter trend trader. Counter trend trading means you're trading reversals. You're buying something really weak or you're shorting something really strong. And I always find it really difficult to trade against the trend. I found in my entire career that I've done far better joining an established existing trend and riding that to the next level. So when I'm using these types of indicators, these are sort of like a red light or a green light. So if you're going to use the alligator indicator, the only time you want to be trading is when they're lined up like this: green, red, and blue. When they're lined up, you don't trade when they're against each other like this, because that said that the alligator is sleeping, and nobody makes money when the alligator is sleeping. You don't make money when they're crossed. You only make money when they're open. Unless you're trading to the short side, in which case during a strong downtrend, I guess you would be trading them inversely. But this wasn't really designed for traders who are trading to the short side. This is really designed for momentum trading to the long side. So the alligator indicator is a combination of moving averages where you're trading essentially a unique type of crossover. Now, you probably haven't heard me talk about this a lot, and one of the reasons you haven't heard me talk about it a lot is because when you actually put the alligator indicator on your charts, I honestly find that my charts get a little bit messy. So this chart right here actually has the alligator indicator turned on. So I've got the green, the red, and the blue. So the nose, the teeth, and then the water line. So right here, this whole stretch, the alligator indicator is positive. But right here, we go negative. And it's fairly straightforward to say that, yeah, I probably shouldn't be trading it to the long side in this area, but I see it all the time. Traders who are over trading the backside of the move. So through this whole period, from this point forward, your alligator indicator is negative. It doesn't give you a confirmation. So essentially, you should not be taking any trades in this whole area if you're using this indicator to help you confirm whether or not a setup is worth trading. You'll see that the mouth closes as the green crosses the red, and then as he crosses the blue, he goes underwater and this alligator goes to sleep. So for me, I'm not opposed to using it, but I find it harder to see when I have this many moving averages, especially because of the way they're behind the price. You just can't see it very clearly without making them really bold, which you could do. But then again, you start making these really bold And now it just becomes a bit busy and a little messy. And I'm just not a huge fan of that. This is a stage where the alligator is fully negative, green's on the bottom, then red, and then blue. So of course, wouldn't be trading in that area. So, and you can use this on any time frame. You can use it on the 1 minute, you can use it on the 5 minute, or you can use it on the daily chart. So the alligator indicator is the first moving average. Well, I'm not going to call it a strategy in total just yet. I'm going to add some more detail to it, but that's the first thing that I wanted to share with you. Now, the second is trading these moving average pullbacks. So a moving average pullback is interesting because if you've been following me for a while, you know that some of my favorite setups include micro pullbacks and bull flags. I'll put some links at the end of this episode to those strategies so you can learn more about them. But the way the micro pullback works is we have the price moving up very quickly, just like this. We have a moment of pullback, and then we surge higher. Now, during this setup right here, the moving average is almost always quite far away because the price is moving so quickly. So there's no doubt that during this entry right here, the alligator is going to be open and eating, hungry. That's a given. But that's not going to help you really get into that trade because at that point, well, the crossover was probably way back here. So if you're trading a breakout of a consolidation period, if you have a period where the price has been going sideways for quite a while and then it starts to break out, you'll see that moving average crossover for the alligator indicator. That's the place to be considering an entry. But when you have something that's moving really quickly and you want to jump on that trend, well, unfortunately, I'm not going to trade a moving average pullback because it's already too extended and the crossovers aren't going to be super helpful. So in this area, I'm trading either the micro pullback or I'm going to trade the proper bull flag. So a bull flag would be a couple of red candles and then maybe a little doji candle here and then first candle making a new high and surging back up. So the bull flag strategy, let's see, bull flag, and then the micro pullback. All right, so these are the two that I would be trading first and second. And then the third is the MA pullback. So the moving average pullback occurs typically when the price breaks out, as it did on this stock here. This is the one I traded today. It breaks out and then it pulls back quite a lot. So if you see this here, you've got these two big green candles and then this high volume red candle, it drops down. And I wouldn't buy that candle right there, even though it is technically the first candle to make a new high. It's not a clean bull flag because too much selling volume on this red candle. It's just too weak. So I wouldn't buy that candle. And I probably wouldn't buy this one either, although it's true that the price came back above the volume weighted average price, which is our technical indicator. Again, given the high volume of this selling candle, given this rejection, I wouldn't have trusted it right here. But then the price dips back down and it comes back up again and pushes up again. But once again, it kind of tops out and then it pulls back. So this is a chart pattern where you're really not getting clean bull flags. You get this sort of pop up and then the drop, and then pop up and then the drop, this pop up and then the drop. But you know what I noticed? I noticed that, wait a second, this price seems to keep finding support around the area of the 20 moving average. So the 20 is this light blue moving average right down here. So we came kind of back down to the 9 here, back up, back down to the 9 right above the 20, back up, back down. And on this wave right here, I started watching it. And I thought, you know, if this starts to pull away right here, what am I looking for? I'm looking for a breakthrough 10, and then I'm looking for a squeeze up to this level. And we actually got exactly that. So the entry on this was actually down here near the moving average, right near this support level. And the great thing about this entry is that you're getting in close to support. So you've got a tight stop. Now this ended up squeezing here up to 10. As it broke this level of $10 a share, that was a breakout. So my first trade on this was getting in on this green candle right here. I didn't get in before that. And the reason I didn't get in before that was because I was waiting for a little more volume. Now, if we look at these candles here, let's see, we've got, this is a candle that has the volume, this green one here. So once we started to get the volume and it started to pull away, this is where I got in this. And what I was looking for was a retest of the high here, a break of 10, and we got to squeeze all the way up to 11. Then we got a micro pullback, and we got to push all the way up to 12, to 13, to $14 a share. So this actually went from $9 to $14 a share. Now, this is a stock that had a news catalyst today where they make wheels for cars, and their wheels are going to be featured on the new Corvette, the new Chevy Corvette. So that's a pretty big headline for this company that General Motors has contracted them to make the wheels for this car. And that was the news catalyst that was pushing this higher. So I'm going to show you two other really good examples of moving average pullbacks in just a moment. Now, the moving average crossover here is sort of goes hand in hand with the MACD. So a moving average crossover, and again, this is a slight variation of your alligator indicator. Your alligator indicator is using the 13, the 8, and the 5 exponential moving averages. I use the 9 and the 20 on my charts. So when the 9 crosses against the 20 and then it crosses back up, those are the crossovers that I'm paying attention to. This is another crossover right here. And so what I've come to learn is that when the 9 moving average crosses below the 20, I should no longer be buying this stock. So the way I use moving averages is they tell me when to stop trading because we've gotten a negative crossover, and they tell me when to start trading. So once we get the positive crossover right here, I'm interested again. So right there at that point, we get a positive crossover, and I'm like, okay, it's game time. And that stays positive until right here. So we ended up having this window from about here to here where all of this price action occurred when the 9 moving average was above the 20. And then as soon as we get that negative crossover, at that point, I'm done and I walk away. Now, for some traders, it can be hard to visualize these crossovers in real time. And so using the MACD is really helpful. The MACD is an acronym for Moving Average Convergence Divergence Indicator. And when the MACD crosses its signal line, that is essentially showing you visually down on this pane right here, this moving average crossover. And in fact, the MACD is formulated so that moving average crossover is going to be a little earlier than when it actually happens with these two indicators, with these two moving averages. So if we pull up the MACD right here, let's see, let me grab my chart. So when we pull up the MACD, there it is. We're going to go full screen on this. So the MACD uses the following inputs. It uses the 12 and the 26. So it's, and then the signal length is the 9. So the 12 is the fast length, the 26 is the slow length, and then the 9 is the signal. And we're watching when the MACD average crosses the signal line. So this cross is actually happening a little bit before the 9 and the 20 crossover. So anytime the 9 and the 20 crossover, just slightly before that, you would have had a standard MACD crossover. Now, the moving average convergence divergence indicator settings that I'm using are the standard settings that everyone uses. They're the standard settings that will be applied when you add MACD to your chart. They're not custom, they're not special, and that's important. I want to see the MACD and I want to see these crossovers the same as everyone else because these are the very clear buy and sell signals in the market. That's a buy signal and that's a sell signal. The reason it's important to see is just like it's important to understand what a stop sign means. You want to make sure everyone who's driving knows what a stop sign means. That creates more, uniformity in the way everyone drives, less accidents. So with trading, having indicators that very clearly say stop or go makes it easier and more predictable to trade these stocks. So for me, having the MACD on there is a must-have. So I have the MACD on because that allows me to visualize when we're having these moving average crossovers. So we've got the alligator indicator, we've got the moving average pullback, and we've got these moving average crossovers. Now, I have this example here that I wanted to show you. This is going to show you where we have the crossovers on the alligator indicator. You can see right there we get a crossover, which is negative. So that tells you to stop trading it there. You get a crossover right here, which tells you to stop trading it. Then you get a crossover here, which tells you to start trading it. So this is stop, and then this is start right back here. That's a crossover right there. This is stop, this is start, and this right here is stop. So when we compare that to our MACD right here, what you would notice is that the MACD indicators are going to be sharper and they're going to be faster. They're going to be faster than the 9 and the 20, and they're going to be a little bit faster than using the alligator indicator. So between the three, I think the MACD is going to be the best one to use for helping you identify when the trend is shifting. Okay. So, and now here we've got, again, CREV, where we've got the alligator indicator turned on. And this right here shows that the alligator indicator was positive. It was already positive. The MACD crossed over right here. And I guess actually in this case, the alligator indicator was kind of somewhat positive the whole time, except that it dipped down for a second right here. And again, this is showing a much more dramatic swing right there. That's showing it much more visually. Like that's the clear break. And that's clearly the spot where this thing went into play. It wasn't really easy in this area, even though the alligator indicator was generally open. It's just slightly lagging behind price action. So here's the way I trade with the moving averages. And we're going to talk specifically about a moving average pullback and one that I took this week that gave me a really solid trade. So I'm going to walk you through each one of these steps. Step one is to find a stock that has volatility and is moving quickly. I'm going to close my video here so you can see this circled area on the chart. So this was on Tuesday, and we had AZTR. This is the stock right down here. Now this stock, at the time I got this screenshot, was up 425% on the day, which is remarkable. Had 14 million shares of volume, a 600,000 share float. The price is $8.52. So this thing is going absolutely crazy. It, in fact, is the #1 leading percentage gainer in the entire stock market. Now, this is the stock that I ended up making about $28,000, $29,000 on Tuesday. So step one is finding a stock to trade. And the way I focus is to look for the stocks that are the #1, #2, or #3 leading percentage gainers. That's usually where I find the most success. Now, once I find a stock that's up 50%, 100%, 200%, whatever's the biggest percentage gainer on that day. Some days the biggest percentage gainer is 50%, some days it's 100, sometimes it's 400, whatever it is. That's the one that I'm going to focus on. Then I try to figure out, why is it up this much? So I'm going to actually give you guys a PDF that you can download. This is my stock selection worksheet. The link is going to be pinned to the top of the comments and linked into the top of the description. So you can download my stock selection PDF, and that'll actually break down for you the 6 criteria that I use to determine whether or not a stock that is up and is the #1 leading gainer is actually worth trading. Because it's not just that it's the #1 leading gainer, it's also a measure of the float, the price, the relative volume, the news, etc. So make sure you guys download that worksheet and then you can use that in your trading. So I'm going to have that link and you guys can check that out right now. You can pause the episode if you want. You could download the worksheet and then you could follow along as we keep going. So step 2 is to check to see what the catalyst is. Why is this stock up this much? So in this case, we had a news headline, and typically there will be some type of news that's driving the stock up, although there are times where we'll see something that's up 50%, 100%, and in fact, there's not a very clear catalyst. When that's the case, if the market is really hot and we've got really strong sentiment, really strong momentum, I will consider taking the trade anyways. But if the market's a little colder, I'll be a little bit more cautious because I'll know that short sellers are going to short this stock realizing, look, it's up 75% and there's no fundamental reason for that. It's definitely going to fade. But one of the things that we know as long bias traders is that sometimes a stock can be up 75% with no news. And the reason is because early short sellers are getting squeezed out. Think about GameStop. The catalyst there was high short interest. So it may not be a fundamental catalyst. It could be a technical catalyst that's driving the price higher. In any case, I looked to try to understand what the news is, and AZTR did have a news headline, so that was good. And then do the market sentiment check, right? So again, if sentiment is strong, I'll be more aggressive on anything that has news. And what I'm ultimately looking for is a fast rate of change. That is the number one requirement, that the price is moving quickly. If the price isn't moving quickly, regardless of how much something is up on the day, I'm not going to want to trade it. I want to see that the price is moving quickly right now. So then step 3 is where we get into technical analysis, and this is where we get into analyzing our moving averages. So I always start by analyzing the daily chart. I check the daily chart because I want to look at the big picture. And so in the case of AZTR, this stock, which will be our case study from Tuesday, I noticed that we had a large gap. The gap was from $8.85, which was the high of this day back here, and that went all the way to the low of this day right here, which was $24.30. So we had a huge gap on the daily chart. A gap represents an area where there is no resistance. There is no resistance until the low of that candle right there. Now, it doesn't mean that we're necessarily going to go all the way at 24, but it certainly shows that we have more potential than if the stock had clear resistance at 875, 880, 9, 950, 10, 1050, 11, 12, etc. Right? Because each time it comes up to that level, it's going to slow down, and then eventually the price is going to roll over. So this had basically no resistance here until $24. I also checked the position of the 200 exponential moving average, and I saw it's up around $27 a share. So that's the average price over the last 200 days, which told me again that this is not going to be nearby resistance. If that 200 moving average was right down here, I would worry about that being upside resistance because most likely the price would hit it and it would fade off of it. But in this case, the 200 EMA checks out. So now my due diligence on the chart is nice gap, lots of room to the 200, recent reverse split, which has the effect of reducing the float of the stock, and we have news today. So check, check, check. This is all looking good. So that's the daily chart. Now we look at the intraday chart. Now on the intraday chart, we've got fast acceleration following the breaking news. We have a micro pullback that occurred right here at about 220. And then we got the first 1 minute pullback, which was right in here. We have increasing volume. The MACD is open. And even though we didn't get a crossover here that gave you the ability to buy. So once again, this is going to be a trade where your first entry is going to be on a micro pullback or the first 1 minute candle to make a new high. It's not going to be it's not going to be a MACD crossover. It's not going to be a moving average pullback, and it's not going to be an alligator indicator trade because the stock basically went straight up. So the only way you're going to be able to take one of those trades is if we get a more sustained pullback that results in a moving average pullback, or we get such a big pullback that our moving averages cross to negative, we go sideways for a while, and then we come back to cross to positive. And then that's when the alligator indicator can come into play or a MACD crossover. So my first trades were right here at the very beginning, trading the standard micro pullbacks and first bull flags. But then we ended up getting a moving average pullback. So the next step is moving into your order entry window and actually executing the trades. So this is what my order entry window looks like. I've got my buy and sell orders down here. This is the level 2 where I can see the depth of the market, and this is where I'm actively trading. So now let's talk about the moving average pullback strategy trade that I took on AZTR. So if we look at this, on the 1 minute chart, this is the 1 minute on the right, and this is the 5 minute on the left. So on the 1 minute chart, we get this quick squeeze up. Our alligator indicator is positive the whole way. It crosses like right in this area, but then it opens again right here. So this is the spot where we got both the alligator indicator confirming an entry and the MACD crossover right here, and we were on a moving average pullback. So what happened here was we had the first of all, we had a micro pullback right here, which I took a trade on. Then we had this pullback right here, which I traded. We had a small pullback here, which I traded. We had another one here, which I traded, and another one right in here. So this is like 1, 2, 3, 4, 5, 6, 7 trades as it's squeezing up. But it ends up doing a little false breakout here and dipping back down. And notice where does it come to support? Right down here along our moving average. Typical, very typical. It comes back up here and actually traded right in this area. And what I thought might happen is a squeeze back through the high and a move higher right here. But that didn't end up working. Ended up stalling out and dropping back down. And then this is where we're no longer looking, this is no longer in this area a bull flag. A bull flag is when we have the very, well, this is actually a bull flag right here. This is where you've got 4 or 5 green candles up, 1, 2, 3 candles that are red. In this case, it was 4, which is a little more than you'd like. 3, 4 candles of pullback, and then it goes higher. But on the 1 minute, this is not a bull flag. It's not an ABCD pattern. At this point, it's just sideways consolidation. But I call it a moving average pullback when that consolidation comes right down to a moving average, and the 20 was just below this, because remember, this is the 5, the 8, and the 13. So we're right at the 20, which would have been right down here. And then what happens is we pull away right there. So this is a moving average pullback. And what's interesting here is that on the 1 minute, we have a moving average pullback, while on the 5 minute, we have something that looks a lot more like a bull flag. 5 green candles up, and then 1 candle sideways, 2 candles sideways, 3 candles sideways, 4 candles sideways, again, right down to that moving average, and then boom, we squeeze from $5 all the way up to 12. That trade right there was, I mean, it was really phenomenal. So I want to actually show you my executions on this move. These are my actual trades, and I'll tell you that I traded it a lot. So my strategy, I guess everyone has their sort of own strategy. My strategy is to get in and get out. So I'm going to get in, I'm going to get back out. I'm going to get in, I'm going to get back out. And so if we look at this right here, you could actually zoom in here and you could see all of these trades. So I was trading the breakout. The green is the buy, the red is the sell. So buying and then selling, and then buying and then selling, buying and then selling. So I'm trading as it's pushing higher. I just continue trading it. It pulls back here for a second. It comes back up. I buy it, I add, and then I sell a little bit. And now right here, I'm flat on the trade because basically it's not working, right? So I didn't trade it through this area right here, and I didn't trade it through this area right here. But right here, as we start to pull away, what happens? I'm back in. So this is the moving average pullback. And what we want to notice is that the stock is holding the support of these moving averages. It's had the opportunity to fail, and it's not failing. The longer it doesn't fail, and the further the price moves just slightly up, creeping higher, the higher the likelihood that we're going to break these levels. Now, what I do is I try to identify what are critical levels on this chart that I should be paying attention to. So in this case, we had a little bit of descending resistance right here. So we had a little bit of a wedge. The wedge was sort of in this area here. And I thought if we break the high of this candle right here, and the high was $5.41, we're going. And so I decided to get in right down here, knowing that my stop was just below the low of this pullback. Remember, when we're looking at 5-minute charts, your stop is always the low of the last 5-minute candle. So the low of this last 5-minute candle was like $5. So when I got in at about $5.15, $5.20, I only had about a 15-cent, 20-cent stop. My stop was super tight. Now, there was a possibility that I would get in like I did here and have to get back out. Maybe it's a small winner or maybe it's a small loser, but I'm okay with taking that trade, especially given the fact that I know that this stock meets all my criteria for having the potential to make a big move. Again, those criteria are broken down in my stock selection worksheet. That's going to highlight for you the type of stocks that can make big moves. Because if you don't understand the type of stocks that can make big moves, what's going to end up happening is you're trading the wrong type of stocks. You're expecting big resolution. It's not going to happen. You're going to get chopped up. And you're going to realize no one else is trading this. And the reason they're not trading it is because it's not the right type of stock to focus on. It's not the type of stock that has the potential to make a big move. So people are not interested in it. All right. So this is also, by the way, an example of what we call multi-time frame alignment. The 5-minute checks out and the 1 minute is confirming as well. Now, it's true the 1 minute's not a bull flag or an ABCD pattern. It's just sideways consolidation, a gentle moving average pullback, while this is more of the clear pattern. And that's fine. A clear 5-minute breakout is usually going to be more powerful than a 1-minute breakout. So as long as the 1-minute chart isn't telling you something like, if the 1-minute chart, for instance, had a huge red volume bar here with a big topping tail and another one right here, the 5-minute might not show that detail, right? The 5-minute is averaging 5-minute candles, so it can kind of hide little secrets here, like a big, huge red volume bar with a topping tail. It could end up being a green candle on the 5-minute, and it just looks like a small sort of little topping tail. It's not as dramatic. But when you see those warning signs on here, that's going to give you pause to say, well, the problem is the 1-minute doesn't look good. So even though the 5-minute looks good, the 1-minute's got these warning signs. But here, the 1-minute checked out. No warning signs, and now we're getting ready for this big MACD crossover. The stock is consolidating in the top 15% of its range on the day, which indicates very strong bullish sentiment. Traders had the opportunity to short it, sellers had the opportunity to come in, and it didn't drop. And now this is when you get that push higher. So let's jump into, so let's go back to right here. So right here, I end up jumping in right here as we start to pull away. I take a little profit to protect myself, which is always the right move. And then I'm like, oh, this is going. I add back. I add a little bit more. And in here, I take a little profit. I take a little profit. I add, and then I take a little profit. And I just actively trade the range. The reason I add and take profit is because when I'm trading, I'm using the level 2 in my trading right here for my order entry, and I'll see the flow of orders. So I'll jump in, I'll see a lot of buy orders, so I'll jump in also, and then all of a sudden maybe I see a big sell order. I'm like, ooh, there's a 25,000 share seller. I should jump out of this. And maybe the price drops 15 cents, and then I'll add back on a dip, and then I'll get back in, and then it goes up another 25 cents or 30 cents. And then there's another seller, so I take profit, and then it dips down. So the fact is, even stocks that are moving as cleanly like as this are moving in these waves. So I like to add, take a little profit, add, take a little profit, add, take a little profit, and so on and so forth. That for me is the way I've always traded. And part of that was because I learned to trade during a time in the market where winners didn't come easily. And if you didn't take the profit off the table when you had it, that profit would disappear. So I trained myself to take the profit when you have it. And then look, there's nothing wrong with getting back in if you have another setup. So this was the trade on AZTR right here as we started to pull away. And then step 5 is to analyze my metrics. Now, before we do that, let me show you, this is another trade here. This one was on, let's see, I think this was on POAI. Right, okay, so watch this. So this is another really good example here. So right here, we're looking at our 1-minute chart. And let me actually grab, I'm going to pull up the 5-minute chart and just show you what it looked like before we take this trade, or before I show you the recording. Okay, so POAI, this is the one from yesterday, I think it was. So the 5-minute chart looks like this right here. Okay, so this was the 5-minute. And then we're going to back this up, and I'll show you the 1-minute. Okay, so this was the 1-minute. So I'm just going to close these out just to give it a little bit more space. Okay. I'll just close all of this out. It's fine. All right. So on this one here, we had 5-minute pop up, pulls back, squeezes higher, pulls back, little false breakout, and then dips down. So we're sort of in this consolidation right down here. And on the 1-minute chart, I was looking at this right in this area, and what I noticed was ascending support. So I saw, you know what? We've got this support level. Tap, 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 tap. And what I notice is that we're making higher lows. So the low here isn't as low as the previous low, which means we're sort of stair-stepping up. And what I kind of thought was that it was only a matter of time before we got a squeeze back through the high of day. Now, the only red flag with this was this red candle here. You could see we have this red candle here, and it marked sort of this not perfect 5-minute setup. So it's not a perfect bull flag, but this is almost a picture perfect moving average pullback. So you have the dip, the pop up, holding, and I took a starter right here, and then we get this really nice breakout. So let me show you this. So here I was watching this, and we had dipped down to about $2, and I had said I'm watching this off of 2 because it keeps dipping down to 2 and holding, and I feel like if I can get in really close to $2 a share, I'm going to just have a better entry. So I've got my hand on the buy button, and I see a little bit of green come in, and I say, you know what? I'm going to jump in too. I just feel like if I keep waiting, I'm going to miss this move. So I end up getting in there at $2.11, and there is a 26,000 share seller right here at 213. My stop is $2. We break through that seller. There's another seller there at 14, but we broke through that as well. And now we're starting to pull away off of this moving average. Now, as we pull away off this moving average, what's the profit target? Well, initially, I want to see a squeeze to the high a day. But what I'm also thinking is that anyone who shorted for this red candle being a reversal in the high a day is probably going to have their stop at that level or maybe just below that level. So I'm thinking as it gets closer to the high a day, shorts are going to start covering. And when I see that buyer right there on the bid at 222, 17,000 share buyer, I'm thinking, okay, someone's trying to buy shares here. Maybe it's someone trying to cover a short. So I put my new order up and I add to the position here for the squeeze through the high a day. So I'm going to look to add. I add right there at like 23. Brings my average up a little bit to 216. No doubt my average is higher. But I'm looking for that squeeze through the high. And look at this. Right there, we break through to high a day. This candle has almost 1 million shares of volume on it. And I easily was able to take a little bit of profit off the table. So I took a little profit at 27 into the high a day breakout, which, that order was kind of funny because it was like right as we broke this level, it was just sort of like right as that happened, I took a little profit off, and I'm taking a little bit more profit into the highs. So that's 233, 237. So right there, we marked a high of 238, 239. And then what ended up happening here was we had this 30,000 share seller that came out at 240. And we ended up stalling out at this 240 level for a little bit. And then we pulled back again, and then we kind of pushed a little bit higher. But that right there was a moving average pullback. So one of the things that's also important to note is that I love trading around half dollars and whole dollars. So the fact that the stock kept dipping down and holding two, dipping down, dipping down, dipping down, I felt like if I could get in as close to the psychological support of 2 and this ascending support line and the moving average, I had like triple support right under my trade. So that support was only like 10 cents away, which gives me a really tight stop. Now, when we talk about the pros and cons of this strategy, one of the things that is a little bit challenging that you might notice, but you may not, is I'll just go ahead and jump to that, and then we'll come back to the metrics in a second. So when we talk about the pros of this strategy, in a hot market, that long period of consolidation can result in a really large breakout. Many traders, I've got to typo fix that, have the opportunity to participate because the consolidation period offers the ability to take positions in anticipation of the breakout. So people are buying, accumulating while we're going sideways because they're expecting that the stock is going to go higher. They're looking at it and they're thinking, look, this thing has news. I like it. I want to buy it. And so people are buying during this long accumulation phase. But of course, you also have shorts who are shorting, thinking, look, the stock's up 100%. I don't think it has a good enough reason to be up this much. It's going to fade. And then boom, all of a sudden, when it's pushing new highs, they have no choice but to either add to the position, which could make their loss even bigger if it goes higher, or cover it. And so you have double buying here. You have long buyers who are buying for the breakout, and you have short sellers who are covering, and that's what creates that big squeeze. So in a hot market, we have these really nice breakouts. And I'll show you, so let's see. Let me grab my charts here for 1 second. So if we look at, so POAI gave us this nice moving average pullback and then nice breakout here. CREV from today, this one gave us similarly this really nice sort of pop up, pull back, and then pulling away here right off those moving averages. And this was right off of $9 psychological support. It held 9 and then boom, off it goes. And then it held 10, it retested, and then squeezes up to 14. And then we had AZTR, which gave us this really nice pullback, which was also a 5-minute bull flag. So that was right here, the 5-minute bull flag that gave us that squeeze higher, which on the 1-minute chart was more of that moving average pullback. So just that kind of picture perfect pullback. Now this ended up doing a secondary offering the next day, which is why it dropped. But nonetheless, this was the spot right here where it was like strong setups here, here, and here. And then MACD crosses over, it goes negative. So I don't want to trade it here. I don't really want to. Now I did take a trade here and I had enough profit on a stock that I was willing to take that risk with that trade, but it was risky. It drops down and then comes up again. And at this point I was like, look guys, we're holding the support of this moving average. See how we're right at that 20 moving average? The MACD is crossing over. We've got the psychological support of $5 here. It's like boom, boom, boom. Everything is right there supporting it. Now, as a beginner trader, you might not be able to understand initially the psychological levels of support that are there. So you're like, I don't know, I can't quite see the entry. And to be honest, for most beginners, probably a simpler strategy is the simple bull flag or micro pullback, because those are really purely candlestick patterns that are very easy to visualize. The exact entry point on a moving average pullback is a bit more ambiguous. And that's one of the cons of this strategy. So the cons are, well, typically by the time the stock pulls back to a moving average, the MACD's crossed over, the bull flag has already failed, and the stock has shown some weakness. Now, sometimes it's like, well, it's bound to show a little bit of weakness here. It's up 300% on the day. Like, let's be reasonable. So, it's okay, but at the same time, it did stop going, basically straight up. Right? So this was a little bit of weakness here. There's a little bit more selling. The MACD crossed over. And so if this was your first trade of the day, I would say you missed the easier trades, which were right here, here, and here. But if you already got those trades and you're looking to add another strategy to your tool belt, then this is a great one because of that consolidation breakout. So a couple things you could do to help you get better. Draw descending resistance right here to help create the wedge. So visually create the wedge. And then you'll notice here that the apex was right here. This was the spot where the wedge kind of had to break. It broke a little early, and they often will. A strong stock will often break early. But once you break that descending resistance, be aware that sometimes you'll break, you'll retest it real quick, and then you'll go. So just because it breaks and dips doesn't mean it's not going to work. Can it hold above that level? If it can, it's game time. So this is a moving average pullback, a break of that descending resistance, and then that squeeze higher. So watch the descending resistance, look for support. How is the stock behaving around $0.5 and whole dollars? How close are we to a level of support? So right here, we've got our moving average support. We've got the whole dollar. We've got ascending support here, propping it up. So it's like check, check, check. Now, if we look at POAI from yesterday, that one, we'll do that on the 1-minute chart. So this one here, let's see, right in this area. So we're going to do something kind of similar here. So on this one, we had ascending support right in this area. So I kind of connected. I was sort of like, what sort of is like the exact right way? And it's a little arbitrary. You sort of draw it in the way that it feels like it connects in the most spots. So even if you just connected these two spots here, that would have been fine. And then you're like, okay, is this going to work? It does. Next bounce. Yep. Okay, here we go. It's holding this level. That's proving that it's validity. And then on this side, you can sort of draw something kind of like this. Now, this crossing is okay because what happened is it tried and it failed. So it tried and it wasn't able to close above that level. So again, right here, you've got a wedge breakout. You've got this consolidation and then the wedge breakout right there. So draw those lines right there, the descending and the ascending trend lines. Try to connect them where they touch in the most places because that's going to usually be the most valid. And a lot of times you draw a trend line like this and then you look back and you're like, yeah, okay, that actually seems like it's fairly valid. Prices below it, above it, below it, above it, support at it here, below it here. Now in this area, I don't know if this one kind of bounced off of it right here. I often will keep these on all day long because we'll see if we get a big sell-off, we'll bounce off that level and then we'll come back up. If it's been proven earlier, it usually will continue to hold up. So let's see. So now the other cons of this strategy, it does take a little more time for the pattern to form. And breakouts can result in dramatic false breakouts that create the jackknife. So I'm sure some of you have seen these really nasty jackknives. I'm just looking to see if I have a good example of a jackknife here. I don't think I have one at the, I do have one here. Let's see how good this was. Well, this one wasn't a moving average pullback. This is where we did have that ascending support line here. We did pull back, but then we broke below it. So we failed. So that is a jackknife, but it's not part of a moving average pullback. In fact, right here, you could see that the moving averages were crossed over. We were negative. So really shouldn't have taken that trade, but was taking a little bit more risk on that one for whatever reason. So, and I'll say right now, it's better to, as a beginner, err on the side of caution and not take high risk setups. I might feel the comfort to take some high risk setups because of my educated intuition and the profit cushion that I have and this and that, but you want to be more careful. So the jackknife is more common in a cold market where we'll see that breakout, but then it instantly reverses. It's kind of like this, where it pops up and then instantly back down. So that's more common in a colder market, and you've got to be more careful with it. Now, the tools and the skills to trade this strategy, you need scanners, stock scanners to help you find stocks that are moving. I'm using Day Trade Dash. These are scanners that I custom built with my development team. I'll give you a link for a 2-week trial in the description of this video if you want to check it out. You need access to level 2 because level 2 and being able to visualize the way the orders are stacked around the half dollars and whole dollars, or whether to the buy side or the sell side, is very important for active day trading. You'll need hotkeys for rapid order execution, and you'll want software for analyzing your analytics, right? Reviewing your trades, which I use TraderView for that. And when it comes to skill, obviously you need to understand the basics of trading. And if you haven't already checked out my episode of how to start day trading from zero or how to read candlestick charts from zero, those are great episodes that you should definitely watch. You need to know how to use your scanners, how to read level 2. You need to have the discipline to follow the rules of your strategy and to know when to walk away. That's so important. You have to recognize that intuition, the acquired intuition to make quick decisions, it takes time. Not everyone's going to have it, but you need to be able to develop it. You have to have the discipline to cut your losses quickly. And you need a really good ability to read sentiment in the market and to know if this is a current market where the moving average strategy is appropriate. Because if it's not, it's just not worth trading. Now, when we go back to step 5, analyzing the metrics, when the market's hot, I'm going to be a lot more active. I'm going to trade more frequently. I'm going to trade more of my setups, not just my top tier A quality setups, both in candlestick form and even on the type of stocks I'll trade, but I'll open up to trading B and even C quality setups. Because when the market is really hot, it's like the wind is at your back and it just feels like these work better. But when the market is cold, that's when it's time to go back to basics. Go back to doing what you know works. Focus just on your bread and butter. And that's what gets you through those slow patches. So for me, when we had a 30% correction in the market and a big bear market, I hunkered down. I said, I'm going to batten down the hatches. I'm only going to trade the absolute best quality setups as per my stock selection worksheet, which you guys can download. I'm only going to trade my absolute favorite entries, micro pullbacks on the front side of the move, bull flags, maybe ABCD patterns, but probably not long consolidation moving average pullbacks. They're just going to be too risky. I'll still use the MACD and the moving average crossover to tell me when I should and should not be trading a stock, but I'm not going to take that long pullback. And I'm probably not going to take red to green setups, and there's just head and shoulders patterns. There's just certain setups I'm going to say, you know what, this isn't the market to take those trades in. So your analytics will help guide you to what's working for you, both on a day-to-day basis, but also on sort of a weekly, a monthly, and an annual basis. And ultimately, when I'm sharing my strategies with you, all of it is informed by these analytics. $12.9 million in profit. And what's the price stock that I make the most money on? What's the time of day I make the most money? What's the day of the week? What's the relative volume? What's the gap? I have all of that data. And that's, of course, what I share with all the members that are in our full-length Warrior Pro course as part of the curriculum, and with students who are streaming every single day while I'm trading. So listen, if you enjoyed this episode, I hope you hit that thumbs up. I hope you're subscribed to the channel. And I'll remind you again, as always, that listen, trading is risky. So manage your risk, take it slow, and practice in a simulator before you put real money on the line. And I'll see you for the next episode real soon.